Hello savvy investors, and welcome back to Investor Insights. This is the third video in our investment series. In the last video, we discussed the types of traders and investors in the stock market, the techniques they use to earn money, how they buy stock, and much more. Make sure to check it out. In this video, we will delve into how to choose stocks for investment, exploring what we need to know before buying stocks. So whether you're an intermediate investor or a beginner just starting out, this series will undoubtedly help you understand the essentials of investing. Your journey toward financial literacy and empowerment is pivotal to us, and we are here to navigate through the complexities of the investment world together. So grab a snack, not just popcorn. Hit that subscribe button and let's get started. Choosing a stock for investment requires a thoughtful blend of qualitative and quantitative analysis. Making informed decisions in stock investments typically involves assessing the company's financial health, understanding market and industry trends, and considering various risk factors. It's crucial to acknowledge that each investment carries its own set of risks and potentials, and diversification is key to managing those risks effectively. Selecting a stock can be a complex task because there's no one-size-fits-all method. Remember, there's no guaranteed way to pick a winner, but following this general guide will surely increase your probability of success. These points will undoubtedly assist you as they represent the most common considerations that all investors should be aware of. I'm going to share some key points or parameters with you that you can filter stocks and conduct your own fundamental analysis online. Keep these points in mind. If you're unsure where to analyze stocks, you can use platforms such as Yahoo Finance, among others. Now let's get back to the topic. So the first point is earnings. To see how well a company is doing, look at its earnings. Think of earnings as the money the company makes, like its paycheck. Earnings per share, or EPS, is like dividing the paycheck among the company's owners, who are known as shareholders. High earnings and EPS mean the company is making good money, while low numbers might be a sign of financial trouble. The second point is revenue growth. Check whether the company has consistently made more money or revenue and profit over time, not just during a few good months or years. The third point is debt levels. Think of a company's debt like a person using a credit card. It's okay to have some debt, but too much can be a problem. Make sure the company doesn't owe more money than it can handle. Look at whether it has been able to pay back its debts easily in the past. The fourth point is PE ratio. The price to earnings, or PE ratio, can be likened to a price tag on a stock. It indicates how much people are willing to pay for every dollar that the company earns. A high PE ratio might suggest that the stock is expensive relative to its earnings, while a low PE ratio might signal that it's a bargain. However, exercise caution. A low PE can also signify the investors are concerned about the company's future. It serves as a tool to assist in determining whether a stock is a prudent purchase. The fifth point is balance sheet. Think of this as a snapshot of a company's finances. When you compare assets to liabilities, you're gauging the company's financial health. Just so you know, assets refer to things the company owns, like buildings, money, and products, while liabilities pertain to what the company owes, such as loans and bills. A company with significantly more assets than liabilities is typically in good shape. Conversely, if it owes more than it owns, that might be a red flag. The sixth point is return on equity, or ROE. Think of ROE as a report card for a company's ability to manage its money. It plays a crucial role in understanding how efficiently a company is using the money invested by its shareholders to generate profits. Essentially, a high ROE usually indicates that the company is effectively creating profits with the available funds. However, it's pivotal to view ROE in the context of the industry by comparing it with other companies. This comparison provides insight into what is considered a good ROE within the specific industry. Ultimately, by scrutinizing ROE, investors can glean a more lucid insight into a company's financial performance from the viewpoint of its shareholders. The seventh point is profit margins. Think of profit margins like the leftover money after a company sells something and pays off what it costs to make it. For example, if a company sells a toy for $10, but it costs $6 to make it, the profit margin is left over $4. This margin is super important because it tells us how much the company gets to keep after making sales. A healthy profit margin indicates that the company is keeping a good amount of its sales without spending too much on production or other costs. Essentially, understanding profit margins helps investors see how well a company is managing its costs and maintaining profitability, which is vital for its long-term success and growth. The eighth point is valuation. Valuation is like the process of price checking in the stock market. It helps investors figure out whether a stock is a good deal or possibly too expensive. This is super important because smart investing isn't just about finding great companies, but also about ensuring you're not overpaying for their stocks. Investors use different metrics such as the price to earnings, PE ratio, price to book, PV ratio, and price to sales, PS ratio, to understand whether a stock is priced fairly. These ratios provide a way to compare the stock's price to the company's earnings, book value, and sales, respectively, offering insights into whether the stock might be overvalued or overpriced. The ninth point is dividend history. Think of dividends as periodic bonuses companies might distribute to their shareholders. If passive income or making money without having to sell your investment appeals to you, then paying attention to a company's dividend history becomes crucial. Scrutinizing whether a company has reliably distributed dividends in the past and evaluating its current financial stability gives insight into its ability to continue this practice in the future. In essence, a consistent and stable dividend history suggests that a company is likely to keep sharing its profits with shareholders going forward. The 10th point is management. When you think about a company's management, imagine checking who's driving the bus. You want a skilled and ethical team at the wheel. Understanding the quality of a company's leadership is crucial because these are the people who make big decisions and guide the company's future. Investigating the history and behaviors of the leadership team, ensuring they have a track record of making smart and ethical choices, is like making sure your bus driver has a clean driving record and knows the route well. In essence, ensuring the company is in good hands helps you feel confident that it's heading in a positive direction. And the last point is technical analysis. While some might presume that technical analysis primarily serves traders, investors often harness its insights too. Engaging in technical analysis, which encompasses examining price trends, applying moving averages, and performing volume analysis, is crucial for investors to make well-informed decisions. Price trends illuminate historical trajectory of a stock's price, aiding in forecasting its future movement. Concurrently, moving averages refine price data to produce a single forward trend, facilitating the identification of a stock's directional movement. Furthermore, volume analysis, which involves scrutinizing the number of shares traded, validates whether the prevailing price movement is upheld by substantial trading activity. Employing these components provides investors with a comprehensive perspective, assisting them in interpreting potential future stock behaviors. And one thing you should always keep in mind is that understanding your investment goal is essential. It's imperative to clearly define our objectives. Knowing what we want is crucial. Without a clear destination, how can we possibly devise a path to get there? Therefore, establishing clear financial objectives is absolutely necessary. So these are some points that you should keep in mind before buying any stock as an investor. And I'm definitely sure that it will elevate your investment journey. Thank you so much for joining us today. I hope you feel more confident and informed about the stock market. Stay curious and keep learning.